You can afford $2,500 in rent, so why can't you qualify for $2,500 in a mortgage? Before we get into today's topic, hit the like and subscribe button. It really helps other people find my channel just like you. My name is Jimmy Cox. I am a real estate team leader here in Ottawa. If you're interested in working with us, there is a link in the description below, whether you're buying, selling, or even if you just want to just chat about what is going on in today's market. Okay, so let's get into today's topic. So here's the thing, it's the same numbers of $2,500, but the rules between mortgage qualification and renting are completely different. And by the end of this, I want to show you what $2,500 of a mortgage is actually going to cost you over 5 years compared to if you were just renting. Because honestly, once you see that number, it does change the potential conversation. So my first point is why qualifying for a mortgage is harder than getting a landlord to accept you. And it's simply because landlords, they are not playing at the same game or the same rules that mortgage qualifications have to. Now that's pretty obvious because landlords check different things. Most landlords only want to know one thing, is that can you cover the rent? There is a rule of thumb, basically says you want to make 3 times your monthly rent. So if you're paying $2,500 a rent, that's around $30,000 for a year of rent. So they want to make sure that you have about 75 to 90K of income to be able to cover that rent. And that's basically it. That's your check on their credit plus your history with your other tenants and your referrals. That's what landlords are looking into. If you have a history of not paying your bills, I mean, that'll show up and that'll impact your ability to get it. But if your credit score is in the reasonable range, which is above 700, and you have a car payment that's been paid off, and let's say you have some student loans, that's all okay. Landlords usually don't care too much about that as long as you show prior history of being able to pay your rent on time. It's because those debts, those aren't their problems. They're going to look for your references. They're going to call not your current landlord, but probably the previous one from before. Because if you are a good tenant, both landlords will say glowing things about you. But if you were a bad tenant, your current landlord will only say good things to make sure you get out. So keep that in mind, depending if you're a good or a bad tenant. So overall, it's relatively simple. The landlords check your income threshold, they check your credit score, they check your references, it's done. Basically, the landlords just want to make sure you can cover the rent, and that's their bar. What lenders actually check is when you go to the bank or a mortgage broker, it's a different conversation. They're looking for your gross debt service ratio. That's your housing costs as a percentage of your income. And they're also looking at your total debt service ratio. That's every debt obligation you carry, including your mortgage, your property taxes, your insurance, and anything else you owe on a monthly basis. So that car payment, the student loan, the credit card minimums, all of that gets factored in. And if those numbers push your ratios too high, it doesn't matter that you've been paying $2,500 a month in rent for the past 3 years on time without fail. The math just won't work on paper and it won't work in your favor. That's why it's easier to get approved for a rental than it is a mortgage. A lender, they're more thorough and they just have to be. And it's because the lender sees your full financial picture where your landlord only sees half of it, only really the part that they care about. And then there's one more layer that honestly happens when you're going through getting qualified for a mortgage for the first time, and it's the mortgage stress test. Now this one doesn't get talked about very much because it just is a part of their process they put into place. But in Canada, when you apply for a mortgage, the lender doesn't just check whether you can afford the rate that is currently being offered. So let's say today it'd be a 5-year fixed at 4% on average, let's say. Well, they actually stress test you at a higher amount to make sure that you'd still qualify if rates went up when it was time to renew. So right now, that means that they're going to test you at your contract rate plus 2% or up to 5.25, whichever one ends up being the higher number. So let's say you get that 4% mortgage that I mentioned for 3 years. That's a common rate that's available right now. Well, they're going to be qualifying you for up to that 5.25%. And that takes a chunk out of what you can borrow. And this applies to everyone. It doesn't matter if you put 5% down or 20% down. It doesn't matter if you're switching lenders or you're refinancing. The stress test is mandatory across the board. And if you can't qualify for that higher amount, well then you have to reduce your mortgage debt load. So just keep in mind that you're not qualifying just for today's rates of what you can find. You're qualifying for the 2 points higher than that, and that is what we have as the stress test. Now, some people hate this. They find it reduces affordability. Others say it's actually a very good protective measure to make sure people don't overextend themselves. There's probably some level in the middle, but it is an element that is put into place to make sure people don't overstretch their finances. But there are some challenges with it in lowering affordability for people who might need it most. So it's not a perfect system, but it is a decent deterrent of making sure people don't overextend themselves. Second point on this is that your debt is honestly the real problem, because $2,500 looks the same on paper, but your debt on that calculation, it changes a lot of the factoring. So here's a little bit of an industry rule of thumb, and that's going to change for different provinces, different industries, but overall, for every $100 in monthly debt payments that you have, you lose roughly $15,000 to $20,000 in mortgage qualification. And obviously that depends on a bunch of other factors, but overall, that's a rough guide that you can use. Car payments are probably one of the biggest mortgage qualification killers out there. So let's say like a $600 monthly mortgage payment. Well, that might reduce your maximum purchase price by around $50,000. So if you qualified for a $500,000 house with no car payment, well, now you're looking at maybe a $450,000 house if you had that car payment. Student loans are another tricky one. Even if your payments are deferred and you're not making any direct payments at the moment, well, the lender still counts that debt and those payments toward your mortgage qualification. So the total factor is usually about 1% of your outstanding loan balance as the monthly payment, just to give you an idea of like what that payment might be. So if it's a $25,000 student loan, and that roughly comes up to $250 a month added to your debt load, whether you are paying it right now or not. Credit cards are another thing. Lenders will look at your outstanding balances and calculate your minimum monthly payments. So on a $20,000 credit card balance, it can be treated as a $600 a month obligation. And that is a significant difference. And that's, again, another reason why it's more challenging to qualify for mortgage, because your debt just doesn't go away. Like when you apply for a rental, the mortgage company and the lender is going to see all of it. So let's try and put this into some real numbers here. So I ran this through a mortgage calculator, and let's say we take a couple in Ottawa who has a combined income of $100,000, and they have $25,000 saved for a down payment, and there's no debt. So when you run it through certain calculations at, let's say, 4% of interest rate, you qualify for around $464,000 mortgage. Now, that same couple who has the same income, the same down payment, but let's say they're carrying a $500 a month car payment, a $200 a month student loan, and $100 a month minimum credit card payment, that adds up to about $800 a month in added debt compared to couple number one. Now, that $800 a month in debt lowers their qualification from $464,000 of mortgage to $405,000 mortgage, which is a $59,000 less buying power simply because of a relatively small amount of debt they're holding. And it's not because their income changed or because they saved less. It was purely just because of the debt they're walking around with. Even though it's functional debt, it's not bad debt, except maybe the credit card debt. But the car payment, we need to get around depending on your work. Student loans, those are manageable and paid off. But overall, it's still debt that the bank's going to look at, and they're not going to ignore it or pretend like it's not there. And in Ottawa's market, that $59,000, $60,000 in qualification difference, that's a fairly meaningful gap. That could be the difference between the home you actually want and the one you end up settling for. That could be the difference between finding a row home to a semi-detached, depending on the neighborhood and quality of house. You might find a place that's more renovated compared to one that you need to plan for renovations in the coming years. Now, obviously, $2,500 mortgage includes other things. It's not obviously apples to apples comparison. So one thing you have to think about is when you hear $2,500 mortgage, they assume that might be the full number, and obviously it is not. There are more payments that come out of that. So your mortgage payment covers your principal and your interest. So let's say you also didn't put 20% down. Well, then all of a sudden now you have CMHC mortgage insurance rolled into that payment. And that does not also include your property taxes or your property insurance. Those are always on top of your mortgage payment. So when a lender is approving you for that $2,500 payment, they're stress testing the whole picture. It's the mortgage, the taxes, the insurance, they're putting it all together. But what hits your bank account every month in terms of your actual pay in your account, your net income, it's beyond that $2,500. So factor in your property taxes in Ottawa. Let's say it's around $4,000 to $5,000 per year, depending on your home, obviously. Then you have your insurance, and your true monthly cost is going to be closer to $3,000 on a $500,000 home. And it can be varied depending on what exactly the type of home you're buying and where you're buying it within the city. So the $2,500 is just the mortgage, but the real monthly number is higher. Now, renting feels definitely a little bit more safe because there's no qualification stress, but we need to look at the entire picture of what we're trying to get into. Now, the difference between renting and owning a home is fairly different. Like, you can notice the two very strong differences of what you're paying per month. You see the value difference, but there's also equity and investment changes. So let's sort of try to get a better idea of what that full picture comparison actually is. So let's look at 5 years of $2,500 rent in Ottawa. So the math is basic. You have $2,500 and there's 60 months over those 5 years. You're spending $150,000 in rent over those 5 years. And you hand that money to your landlord and you get your house. That's it. You get no equity, there's no ownership, there's no appreciation. There's nothing that's really working in your favor in terms of the asset of what you provided and what you're getting back. You are getting a home to live in. Now, that home to live in, it doesn't mean your renting is throwing money away. Someone has to pay for the house either way. But the difference is the renter has technically nothing to show for it on the housing side beyond the roof that's what's over their head. And obviously there are some things people do to make sure that they invest the difference, and I'll get into that a little bit later. But overall, in terms of what the money is out the door, that $150,000, it's out the door in that 5 years. And we want to see what the same number looks like, but on the ownership side. So let's use a $500,000 house in Ottawa, $2,500 a month. It'll cover your mortgage payment, your principal, your interest, at around 25 years amortization and a 5% rate. So that's a little bit higher, but overall it just gives you a good framework of where we're at. So over those 5 years, you'll pay down approximately $35,000 to $40,000 in your principal, meaning that is money that you can sort of apply to your equity. And if we add in Ottawa's average appreciation, which is around 5 to 6% annually over the past 2 decades, not including some of the COVID pricings, well, that $500,000 house could reasonably sell for, let's say, $635,000 to $650,000 in that 5 year span. So that comes out to roughly $135,000 to $150,000 in equity that's gained of appreciation alone. So just on the asset growth alone. Then you add in the principal that you've paid down, which was at $35,000 to $40,000, and roughly you've now built somewhere around $150,000 to $190,000 over those 5 years of actual appreciation and equity growth. Now, the counter argument is fair, because when you own, you are paying your property taxes, your insurance, your maintenance, and that can be 10, 12 grand a year in additional costs, let alone if you have to change a roof, a furnace, if you have foundation issues, you add in new renovations, new windows, new doors, there are additional costs. It's not just your mortgage coverage. So let's say in the first 5 years of owning a home, you spend an extra $50,000 to $60,000 over those 5 years. So net, if you subtract that from, let's say, the appreciation and principal pay down that you've made, you still might be ahead by $110,000 or $130,000 compared to renting, when you've definitely 100% guaranteed given $150,000 to your landlord and built no asset out of that. And now the only way renting wins this comparison is if you do take the dollars that you're saving from renting to ownership and you invest those dollars on a disciplined, consistent monthly basis. And the thing that we see often is that the discipline required to do that often doesn't happen for many people. I've talked to a lot of people who've had the idea of I'll rent at a lower monthly rate and invest the difference of what it would be if I actually bought a home. But eventually they realize they have this extra few $100 a month, and that just grows their lifestyle spending. Not everyone does it, but it is human nature to want to sort of use that something for immediate enjoyment compared to deferred gains, that what some people are able to do. But it all depends on your ability to be financially disciplined in the moment, compared if you're renting compared to if you are owning. Now, my final point here is the real question isn't really if you qualify, it is what does waiting cost me? And the old cliche saying of investing is it's not about timing the market, it's about time in the market. And real estate honestly works exactly the same. So every year that you wait, the math does get harder. So prices in Ottawa don't sit still in most years. So let's say the market appreciates 5% on average, which, as again I said, happened between 2000 and 2019. That was your average yearly appreciation. COVID hit, was wild, and now we're in a different market, but who knows how this more balanced market will last. So let's say that appreciation of 5% on a $500,000 house, that's $25K that you need to make up to be in the same position you want to be the following year. And so while you are saving your money, whether it's for down payment or for trying to put it into investments and grow, you're also paying that rent, which is money that you will not see again. And the other reality is this: qualifying, it's a fixable problem. Debt can be paid down, your income can grow. A conversation with your mortgage broker will tell you exactly where you stand and what you need to do to get there. That's a concrete plan. And if you're thinking of renting just to wait out the market and hope that the market drops and corrects and all of a sudden you have more affordability, that's not necessarily a plan. It's more of a gamble. And the problem is, historically, especially in Ottawa, that gamble usually goes the wrong way for buyers. They usually sit on the sidelines for too long, and by the time they realize they need to jump in, it changes their amount of what they can afford and the type of house that they can get. So ask yourself this, is that it isn't whether you can afford to buy now, it's whether you can afford to wait. And I know if you can't afford to buy right now, well then of course you need to wait to be able to either save more money or increase your income. But if you have the income to do it and you're simply saving money on a monthly basis, trying to increase your down payment, it might not be worth the wait. So here's where it all lands. The $2,500 in rent to $2,500 in a mortgage, they look identical on paper, but they do operate completely different rules. They build different futures, and qualifying for a mortgage is harder. There's the stress test, the debt ratios, the full picture. It is more scrutiny than a landlord will ever apply to your application. And your income and debt load is the single biggest things that are standing between where you are and where you want to be. But here's what I would leave you with today. It is solvable. If you're carrying debt right now, that's a conversation to have about figuring out a way to reduce your debt load. A mortgage broker, they can help map out exactly what your numbers look like and what you need to get to where you want to be. It's not complicated, it just takes a plan and some discipline. So thanks for watching, and I'll see you on the next one.